Greetings, everyone. This is Rajat Kush, your facilitator, and today we are going to talk about options pricing. I've divided this training into two sub-modules. Today, I'm going to cover first module where we are going to discuss about options pricing, what are the elements which affect the pricing of an option. And in the next module, we are going to talk about two major models which have been used for pricing options. So let's start. Option premium valuation. So these are the questions which always pop up into the heads of people, that how the option prices are decided. The question is, from where do we get the option pricing? On what basis did market participants come to these values of the premiums? What are the parameters that affect these values? Are these parameters fixed by the stock exchanges or by the regulator? Similarly, is the pricing fixed by the stock exchange or by the regulator? So these are the questions. And here are the answers. Any options value increases or decreases depending on different variables. And we are going to look into these different variables, and we are going to figure out that how they affect call options or put options. The impact can be same or different for a call and a put option. Most of the time they are actually different, because put option is when you are bearish, when you're betting that the prices should go down, and call options are for bullish viewpoint. I'm talking about holder of the option, right? Option premium is the sum of intrinsic value and time value. Always remember this. Intrinsic value plus time value is equal to the price of the option. Now, certain times you might not get any intrinsic value because maybe your option is out of the money. And certain times you might get very small time value, because time value depends upon that how much time is left for the expiration. So as long as the option is not expired, there will always be some time value, but consider this as time decay. Rather than time value, it is time decay, because as the time passes by, the value of the option, the price of the option will start decreasing. So these are the five fundamental parameters which affect the pricing of an option. The first one is the spot price. Second one is the strike price. Next is the volatility of the underlying asset price, time to expiration, and interest rate. These are the five major Greeks which affect the value of any option premium. So let's start with the first one, spot price. The option premium is affected by the price movement in the underlying instrument. Simply put, if you are trading, let's say this is a stock A, and if you are trading on a call option, you have bought a call option on stock A. So as the stock A starts going up, the value of this option will start going up as well, right? If you have bought a put option, that means you're expecting the price of stock A to go down. So as the stock prices are going up, the value of this option will start going down, correct? So this is the first element. So if the underlying asset price goes up, the value of the call option increases. Similarly, if the underlying asset falls in value, the value of your call option decreases and the value of the put option increases. But please remember, the movement, the increase in the premium will not exactly be proportional to the increment in the value of the stock. More or less, it depends on other factors which we are going to consider. Plus, it also depends upon how far is your strike price. So let me explain you this with an example. Let's say stock A is at 10 dirham as of now. The call option which you have purchased is on the strike 10, and you have paid 1 dirham as premium. Okay, option premium. Another person has bought a call option at a strike 15, and this person has paid 20 fills as option premium. All right. Now, when the stock moves from 10 to 11 dirhams, you might see a huge jump in this particular strike price, because right now it is ATM at the money, but since stock has gone up, it has become in the money. So you might see a jump of, let's say, 60 fills, for example, right? But in this option with a strike of 15, you might not see a jump of 60 fills, because this option is still out of the money. It is still very far away, deep out of the money from the current stock price. So you might see a jump of maybe just 10 fills in this particular option, right? So the point is, stock price going up definitely is going to bring the price of the call option to the upside. But how much it should go up will depend on other factors as well. One factor which I've just explained to you is the strike price. Now have a look at the strike price. If all other factors remain constant, but the strike price of the option increases, intrinsic value of the call option will decrease. What do we mean by this? An option with a strike of 10 might be available for 1 dirham, but an option with a strike price of 12 will be available for 60 fills. A stock option on the same stock I'm talking about with the same maturity, let's call it a 1 month maturity, a stock option with a strike price of 15 might be available for 20 fills. So you see, as you move away from the spot price, as you move away from the spot price to the upside, the value of the option which you're going to get is going to fall. Because for 10, strike 10, there are good chances that you will be profitable at the end of maturity. That's why the seller wants to charge higher premium. But at a strike price of 15, stock has to go up 50% for you to become profitable. The chances are less, the probability of success is less for you. So in this case, the seller of the option will be happy even selling this option to you just for 20 fills, right? So this is the significance of your strike price. Then comes the volatility. Volatility is the magnitude of the movement in the underlying asset price. So what is volatility? Fluctuation. A stock which has a volatility of this will have higher option pricing. But a stock with this much volatility will have a lower option pricing. And why is that? Let me give you an example. Let's say there is a person who wants to bet with you that he is going to lose 10 kgs of weight in 1 year. And the bet is that if he is able to lose 10 kg, you give him 10,000 dirham. If he is not able to lose 10 kgs, he will give you 10,000 dirham. Correct? Now, you are, let's say, 50-50 on this deal. You are not sure that whether this target is achievable or not. Now, if you come to know about the behavior of this person, that this person is very volatile, just he is target crazy. So to achieve his target, he can go to any level. Now, for you, the chances are then that this person will be able to achieve the target. So for you, the risk is high because of his volatile behavior, the volatility is high. So you might charge more premium from him, right? You might say, okay, if you win, I will give you 10,000. But if I win, you have to give me 20,000 because your behavior is quite volatile, correct? So increase in the volatility increases the value of the option. And it doesn't matter, it's a call option or a put option, both the values for both these options will go up. So higher volatility of stock, higher premium, right? Because greater possibility of buyer achieving the target. So higher volatility, higher premium, lower volatility, lower premium for both calls and puts. The next one is time to expiration. All right. Always remember this as time decay. So the effect of time to expiration on both call and put option is similar to the volatility on option premiums. Let me put it in the same example, the previous one. Now this person is saying that I will lose 10 kgs in 1 year, correct? What if I change this parameter? What if I say that this person is saying that I will lose 10 kgs in 1 day, correct? Now, since the timeline has reduced so much, you know that the chances of this person achieving the target are quite less now. So you might be okay with paying him 10,000 dirham if he loses 10 kgs in 1 day, and you're happy if this person gives you only 5,000 if he is not able to lose 10 kgs. Why is that? Because you are kind of sure that not possible, because the time is not there on his side. So the longer the maturity of the option, greater is the uncertainty for you, higher premium you are going to charge. All right. So options are known as wasting assets. So if everything is flat, nothing is moving, stock is just dead at this point, all factors are constant. Because of this only, because of time decay, the option price will start falling down because every day time is passing by. Then comes the interest rate, the last one. Interest rates are slightly complicated, tough to explain, but let me put it in a way which might resonate with you. If interest rate in the market goes up, people will tend to sell their equity positions, and then they will put this money in the bond market because now bond market is paying higher interest rate. But these same very people still wants to have an exposure in the equity market. So by selling their equity shares, they will start buying call options. And this option will give them the same kind of exposure in the equity market. So this is the logic. Okay. So now interest rates have greater impact on options with individual stocks and indices. Put it simply, if interest rate goes up, the value of the call option will go up and the value of the put option will go down because of this very reason. So in summary, any options value increases or decreases depending upon different variables, depending on different Greeks, which we talked about till now. Option premium is the sum of intrinsic value and time value. Intrinsic value may or may not be there depending upon whether your option is in the money, at the money, out of the money. If it is out of the money, probably there will not be any intrinsic value. If it is in the money, definitely there will be some intrinsic value. Spot price, strike price, volatility, time to expiration, and interest rate. All these Greeks affect the value of your call options and put options. I hope you enjoyed this session. Hope to see you in the second module, in which I'm going to cover two main models to price options, binomial and Black-Scholes model. So see you there in module 2. Thank you so much.